Testing 1, 2, 3, 4. Peter Piper, 1, 2, 3, 4. Testing 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 1, 2, the Honorable W. Thomas Reeder, Jr. Testing 1, 2. Testing 1, 2, 3, 4. 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 1, 2, 3, 4. I'm definitely.
A quorum being present, the Subcommittee on Health, Employment, Labor, and Pensions will come to order. Good morning and welcome to today's subcommittee hearing on the financial challenges facing the Pension Benefit Guaranty Corporation and, more importantly, the impact to workers and retirees. George Miller was a proud liberal lion of this committee. While we very often disagreed, in the years that I served with him on this committee, I admired his commitment to ensuring Americans have the ability to retire with dignity. In 2014, he worked with John Klein, then our chairman, to try to solve a real problem, a retirement system on the brink of collapse. They put politics aside, worked with employers and labor unions, and negotiated a set of reforms to the multi-employer pension system in order to preserve benefits for millions of workers. President Obama signed this bipartisan approach into law in 2014. The law was based on the premise that the plan trustees, who have a legal and moral obligation to pensioners and workers, would have the ability to take early action in order to avoid disaster. While the 2014 statute was an important step, regulations written by President Obama's Treasury Department implementing the law made it difficult, if not impossible, for trustees to use the tools the law contains. And so the problem continues. We know they persist because the Pension Benefit Guaranty Corporation, the backstop for private defined benefit plans, released its annual report 2 weeks ago. According to PBGC, more than 100 multi-employer plans are expected to fail, in addition to the 72 that already have. This kind of widespread collapse will directly impact the millions of workers, retirees, and their families who spent their careers planning their retirement with these promised pension benefits in mind. And who promised these benefits? Unions and employers who established and administered these plans. The federal government and non-union workers had no role in negotiating the contracts that made the promises that will be broken. Mr. Miller, when he chaired the committee, recognized this. That's why this committee, under his leadership in 2009, refused to advance legislative proposal to put taxpayers on the hook for these promises. Implementation of the 2014 law has been ineffective, and the workers and retirees in these plans are worse off because of it. When their plans fail, their benefits will be cut, in many cases significantly. And when these retirement systems fail, the PBGC will collapse as well. The agency's multi-employer insurance program currently has about $2 billion in assets, receives less than $300 million in premium revenue annually, and has a long-term deficit of $65.1 billion. Again, that's $65 billion. When the money runs out, likely sometime in 2025, pensioners will receive pennies on the dollar of what they were promised. Employers will close their doors, and previously healthy plans may go bankrupt. Congress took bipartisan action just 3 years ago to prevent this looming disaster. We believe the Trump administration will work hard to ensure the law's tools are utilized more appropriately. But if Congress is to consider further reforms, it's critical that the committee fully understand the scope of the financial challenges facing PBGC, no matter how dire they are. Today's witness, Tom Reeder, is the PBGC's director. He administers not just the multi-employer insurance program, but also the agency's very large insurance program for single-employer defined benefit plans. While the finances of that program are trending upward, it is still underfunded by nearly $11 billion. The The program insures more than 27 million Americans in more than 22,000 pension plans. We look forward to examining that program in today's hearing as well. There are no easy answers to these problems, but we owe it to workers, retirees, employers, and taxpayers to put top politics aside, as we've done in the past, and work toward finding a fiscally responsible, bipartisan solution. Millions of Americans are counting on us. Before I yield to Ranking Member Sablon for his opening remarks, I want to yield to Chairwoman Fox for a brief comment.
Thank you, Mr. Chairman. I want to take a moment to recognize a member of our staff, Andy Banducci, who's leaving the committee to pursue a new opportunity across the Capitol as the Labor Policy Director for the Senate Committee on Health, Education, Labor, and Pensions. Andy's been a valued member of our team since 2011, most recently as the committee's Workforce Policy Council. He's been at the forefront of our efforts to help America's workers save for retirement, modernize the multi-employer pension system, preserve access to affordable retirement advice, and to expand access to affordable health care for all. Over the years, Andy worked diligently in support of our committee's workforce policy agenda and has helped us to advance important legislative initiatives, including, most notably, as Chairman Walberg just talked about, the Bipartisan Multi-Employer Pension Reform Act of 2014. I know all our current and former committee colleagues would agree. Andy has always provided us with wise counsel and important technical expertise. Many of our successes would not have been possible without his commitment, hard work, and positive demeanor. Andy, on behalf of myself and the members of the committee, thank you for the time and devotion you've put in to doing the people's work. Of course, we know we'll have an opportunity to stay in touch, and we wish you all the best as you embark in this new chapter in your congressional career. God bless you.
Will the gentlelady yield?
Yes, I will.
Thank you. Mr. Chair, I want to join in the best wishes to Andy. The chairwoman has indicated that our staffs work very well together, even in issues where there's disagreement. And that's so important in getting good legislation passed. Andy has been a constructive staffer and will be missed. And we again I want to join in the congratulations of the chairwoman and wish you well. Yield back.
And Andy, I too want to echo the same sentiments, though I would alter a bit. I know you're taking a lateral transfer, but we know that you will give great benefit to that other body with truth and clarity that maybe they've been lacking for quite some time. I also want to add an additional point that while you have done this with all good humor and support and optimism, positive in moving forward and giving us good counsel, you've also been very good at telling me no. And sometimes the best thing you can hear from good counsel is no. So you have a chance then to understand what is actual truth and what we can and can't do and how we need to move forward. So I too, Andy, would say thank you for your service. It has been invaluable. We are blessed in this committee that there will be other staff that follow you that will do excellent work. It just happens with this committee and subcommittee. So we're not worried about that, but they'll have to prove themselves. You did. God bless you as you move forward. Now I yield to my ranking member, good friend and colleague, Representative Sablon.
Thank you, Mr. Chairman, and good morning, everyone. Let me start also by recognizing and thanking Mr. Andy Banducci, who is departing the Majority Committee staff this week. Andy has honorably served the committee for 6.5 years and has played a leadership role on several important retirement security issues. On behalf of all of your friends, Andy, on the Democratic Subcommittee members and our staff, friends all to you, I want to thank you and wish you well as you transition to the Senate. Just don't forget to recognize House members when you're a Senate staff. I want to express my thanks to Chairman Wahlberg. Since I became ranking member, we have sought common ground on ways we can help Americans retire with financial security. Last month, we introduced legislation that updates a 2-decade-old standard for automatic IRA rollovers. And in May, we conducted a subcommittee hearing where there was a fair amount of consensus on practical retirement security solutions. At the conclusion of that hearing, I noted how the multi-employer pension system and the looming insolvency of the Pension Benefit Guaranty Corporation, or PBGC, demands our immediate attention. So I appreciate Chairman Wahlberg's willingness to convince today's hearing. Welcome, Director Reeder. I enjoyed meeting with you yesterday, and I look forward to your testimony. I'd also like to recognize some of the members of the miners, Teamsters, or union, who also, some of you came to my office yesterday. Mr. Chairman, it is clear the multi-employer pension program remains in significant financial distress. As the PBGC's 2007 annual report notes, the multi-employer pension program has $2 billion in assets to cover $67 billion in liabilities. That's a deficit of $65 billion, up from $59.8 billion last year, and an all-time high. The PBGC also estimated that unless Congress acts, the multi-employer pension program is likely to run out of money by the end of 2025. That's the present estimate. We have to focus on the biggest cause of the crisis, the looming failure of a few very large multi-employer pension plans. If Congress works together to help these failing plans, we can go a long way toward improving PBGC's financial outlook. Several of my subcommittee colleagues and I recently co-sponsored Congressman Neal's legislation that proposes a solution to prevent troubled multi-employer plans from failing while safeguarding retirees' hard-earned pensions. I would be interested to hear Director Reeder's thoughts on Mr. Neal's bill. The bottom line is that Congress must address the multi-employer pension crisis, and we must act soon. As we proceed, I believe we should be guided by the simple principle that it is not the fault of the workers or the retirees that their pension plan is on the brink of insolvency. These Americans worked a lifetime and earned their pension. American workers don't want a bailout. They just want the pension promise that was made to them to be upheld. We must also keep in mind that the cost and consequences of inaction are enormous, and the consequences will be devastating. Impacted retirees could see catastrophic reduction to their pension benefit as high as 90%. Governments will see reduced tax revenues from impacted pensioners. There would likely be significantly increased social safety net spending. Employers throughout the multi-employer system will be impacted. Some may have to file bankruptcy, while others may have a worsened financial outlook due to having absorbed additional pension liability. The economic fallout will touch most all of our congressional districts. Today's hearing should provide subcommittee members an understanding of the scope and magnitude of the multi-employer pension crisis. But more importantly, Mr. Chairman, today's hearing should underscore the urgency for Congress to take responsible action to prevent the foreseeable collapse of the multi-employer pension program. I hope that we can do that sooner rather than wait till the last minute. And I'm hopeful we will do that. With that, Mr. Chairman, I want to thank you again for convening today's hearing, and I yield back my time.
I thank the gentleman. Pursuant to Committee Rule 7C, all members will be permitted to submit written statements to be included in the permanent hearing record. And without objection, the hearing record will remain open for 14 days to allow such statements and other extraneous material referenced during the hearing to be submitted for the official hearing record. It's now my pleasure to introduce our distinguished witness. Mr. Tom Reeder was confirmed as the director of the PBGC in 2015. Prior to joining PBGC, he practiced employee benefits law at private firms. Following private practice, he joined the Treasury Department, where he rose to the position of Benefits Tax Counsel in 2005. In 2009, he started serving on the staff of Senate Finance Committee Chairman Baucus, and then joined the IRS in 2013. I'll now ask our witness to raise your right hand. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? Thank you. Let the record reflect Mr. Reeder answered in the affirmative. Before I recognize the director to provide your testimony, let me briefly explain our lighting system. I think you know the lighting system, so I won't go through the script here. It is a system that we generally follow on the road. Green, go; yellow, start to stop; and red, stop. We want to hear your full testimony, though we have your full testimony written form, and then after that have the opportunity for our committee here to ask questions. So we welcome you, and thank you for your testimony.
Thank you, Chairman Wahlberg, and Ranking Member Sablan, and members of the subcommittee. I very much appreciate the opportunity to appear before you today to discuss the key challenges that PBGC faces. As you mentioned, my full testimony has been submitted, so I'll focus on the most pressing issue facing us today. Congress established the PBGC in 1974 as part of ERISA to provide basic protection for participants' benefits in defined benefit pension plans. Under ERISA, PBGC insures plans without regard to their financial situation. Today, PBGC insures benefits for nearly 30 million people in the single employer program and about 10 million people in the multi-employer program. While each program protects pension benefits when plans fail, the guarantees, the premiums, and other features differ significantly. By law, the assets of one program can't be used to pay benefits under the other. Both programs have been in deficit for about 15 years, and however, the financial condition of the single employer program has, as the chairman noted, has been steadily improving, but the multi-employer program is in dire straits and getting worse. As of September 30th, the single employer program had $117 billion in assets and liabilities of $117 billion and assets of $106 billion. So there's still an $11 billion deficit. Our projections show that that will improve, but it's not a certainty. By contrast, as the chairman noted, we have $67 billion in liabilities in the multi-system and only $2 billion in assets. That's a $65 billion deficit, and it's likely to become worse, and we project that the program will be insolvent, more likely than not to be insolvent by the end of 2025. That's due to many factors: financial, economic, and demographic. And the recession of 2008, 2009 amplified the effects of each of these factors. As a result, the funded status of the multi-employer program fell below 50% after the 2008 crisis. Many plans have recovered, but about 10% of them didn't and probably will not recover. So today, the multi-employer program faces an unprecedented level of plan failures. Over 100 multi-employer plans with more than 1 million participants have already reported to their participants that they expect to fail within the next 2 decades. PBGC, our financial statement with some of these plans already on our balance sheet, reflects the serious underfunding of these critical and declining multi-employer plans. Our projections report shows that this underfunding is likely to increase our deficit as the years come. And as I mentioned, we're likely to be insolvent by the end of 2025. With PBGC's multi-employer funds exhausted, when and if they get exhausted, the only money available to pay plans or benefits under plans will be the annual premium revenue that we collect, which is now a little over $200 million a year, and it's projected to grow to $400 million a year. So we're paying billions of dollars in obligations with millions of dollars of income. Multi-employer guarantees are already very, very low compared to the single-employer program. And so a failure of the PBGC's multi-employer program will result in those low guarantees becoming even lower, much lower. Right now, if you have 30 years of service, your guarantee level is a little under $13,000. That compares to the single-employer program, where your guarantee, regardless of your service, is more like $64,000. So one of them's livable and the other one's not quite livable. Cuts of this size are catastrophic to participants. We will continue to work with the administration, with Congress, and the multi-employer plan community that includes both participants and the plans themselves to address this problem, and I look forward to addressing your specific issues in the coming few moments. Thank you.
I thank the gentleman, and I thank you for giving us information difficult to hear. But as my father used to tell me, there's no ability to achieve solution unless you know the full facts and the depth of those facts. So I appreciate that, and I know that you have further responses to the questions we have. I now recognize the chairwoman of the full committee, the gentlelady from North Carolina, Ms. Fox.
Thank you, Chairman Wahlberg, and Director Reeder, thank you so much for being here today. As Chairman Wahlberg has said, we need to know the facts. We need to know the story. A lot more attention is being paid to the issues related to pensions and retirement in the country, and it is important that we have the baseline to deal with, and we want to work with you on helping to solve these problems you're presenting. You talked about the single employer pension insurance program being in better financial position. Could you discuss how the reforms to the single employer pension plan made in the Pension Protection Act of 2006 have contributed to this stability? And do you have some recommendations on reforms that Congress should consider to the multi-employer pension funding rules?
Yes, thank you, Madam Chairman. I do believe that the Pension Protection Act included significant funding reforms. They included reforms in both the single and the multi-world, but the funding rules in the single world have much more teeth. There's more consequences to failing to follow the funding rules in the single employer world. And just as importantly, with PPA and subsequently enacted legislation, the premiums that single employer plans pay is more consistent with the benefit and the guarantee level that's provided under the single employer world. And I think the primary effect of the PPA on the single world was the teeth in the funding rules. That, including those kinds of teeth in the multi-employer world, would help prevent the program from getting worse, but I'm not sure that funding rule changes would help us dig out of the problem that we're in the multi-world. The problem we're in is so deep that it's difficult to dig out of without some other funding source other than we can't fund up all the multi-employer plans quickly enough to avoid the disaster.
Thank you for that. I was here in 2006, and many people have heard me say this comment. I was on this committee Chairman Boehner said to us on the morning that we had the markup, he always wondered why nobody had done any pension reform for 30 years. And then when he got into it, he realized it was very hard work. And those words have stuck with me since that time. We know also from your comments that too many pensioners may not receive the benefits they were promised. When the plans are terminated, what liability attaches to contributing employers? What liability attaches to unions who participated in making these promises?
When the plans terminate, if they completely terminate, there will be a withdrawal obligation, a withdrawal liability obligation on the part of all the participating employers who were contributing to the plan. And they will have to contribute amounts equal to the underfunding up to certain limits. That's if the plan terminates. Oftentimes when a plan becomes insolvent, it doesn't necessarily terminate, and the employers can continue to contribute at the same rate that they were contributing. But if it terminates, the employers would have withdrawal liabilities. The unions would not have a liability.
Thank you very much. I yield back, Mr. Chairman.
Thank the gentlelady. Now I recognize the ranking member of the full committee, Mr. Scott.
Thank you, Mr. Chairman, and Mr. Reader, thank you for being here. What we're facing is a problem of arithmetic in the multi-employer plans. PBGC, as we've heard, has $2 billion in assets and $67 billion in present value liabilities. And according to your testimony, Mr. Reader, the PBGC will need to make about $2 to $4 billion a year in pension payments with a premium revenue of only $400 to $500 million. So the problem is imminent, and it reminds me of the old saying, nothing focuses the mind in the morning like an execution scheduled later that night. I hope this hearing helps focus our minds, and that we recognize that bipartisan action on this matter cannot be postponed later. As you pointed out, the longer you wait, the more difficult and more expensive it is to solve the problem. And so we can talk about the problem. I think you've articulated the problem. Let's see what some kind of solutions there may be. First, let me ask whether or not the premiums of multi-employer programs are sufficient.
I think the multi-employer program has premiums that have been too low for too long. They were $9 per participant until 2012, and they increased to $28 today, and they're indexed now. That is below what I believe is a market rate for what it would take to insure that kind of benefit, especially when the insurer has no ability to decide who it's going to insure and who it's not. As I said in my testimony, we cover all plans regardless of their condition. I think that the premiums are still too low. I realize that raising them is difficult, but I don't think they reflect the economic reality of the obligations we have.
Are there any ways to set premiums in a risk-based way so that we recognize not only the present solvency based on assets, but also assess the risk based on the quality of the assets? Is there any plan that you know of that could set premiums like that?
The administration has included in its most recent budget a proposal that would restructure the multi-employer plan premium so that it would have a risk-based element. It's a variable premium rate that increases with the level of underfunding. That is not exactly a risk-based premium like you suggested, but the single employer world has that variable rate premium, and it's one of the reasons why the single employer program is doing better, because plans have an incentive to fund up their plans employers have an incentive to fund up their plans to avoid that variable rate premium.
That's based on present level of assets.
Yes, sir.
Do you have any examples where you could look at the volatility of the plan, the quality of the assets, and base premiums on that?
I'm not aware of any proposal, a concrete proposal to do that. There have been proposals in the single employer world to have a risk-based premium based on the financial condition of the sponsor, but they have been rejected. I mean, that proposal has been made by every administration I'm aware of, back to President Reagan, I believe, that they have a risk-based premium in the single world, but it's been rejected every time it's been proposed.
Are there volatility assessments anywhere else that you're aware of?
I'm sure insurers
do they have a plan in the United Kingdom that allows that kind of?
Yes, the United Kingdom does look at the quality of assets.
And base the premium on that, based on the quality?
Yes.
So that those who are volatile and likely to go broke would pay a higher premium than those who have invested in more stable, safe assets.
That's correct.
Is there anything else we can do to address the fact that every 20 years the stock market goes broke?
Well, again, I point to the single employer world where plan sponsors are using liability-driven investments that match the volatility of the assets with the timing of the obligations. And as plans become more fully funded, they invest more in fixed income securities.
I thank the gentleman. I recognize myself now for my 5 minutes of questioning. Director Reeder, again, thanks for being here. The multi-employer insurance program has a deficit that exceeds $65 billion, as we've indicated so far. In town halls throughout my district, including one just this past Monday, I've heard of the devastation facing pensioners who are worried that they will not receive what they promised, as well as employees, present employees, who are paying into a system that they believe will not have any benefit for them as well. I've heard from businesses that feel the same way in the present situation and feel captive. While I share their frustration and anger, I certainly don't share their reality. I'm not dealing with that, and I don't think anyone here at in the desks looking down share that same reality. But the frustration, the anger that we hear is important to recognize. In your opinion, what have been the major contributing factors causing these looming plan insolvencies?
It is a combination of factors. It's demographic, it's economic, and it's investments. I think it's also been regulatory as well. I think there were periods in the history of multi-employer plans when the amount that was bargained for to be contributed to the plans is more than the plans needed. The plans were fully funded, and yet employers and employees to bargain for contributions to the plan. And in order to make those contributions deductible, because under the tax code they're not deductible if they're more than is required to be held, the plans reacted by increasing benefits. And then in hard times, like Congressman Scott recognized it, in hard times, when the value of the assets fell, you had these higher benefits that were very difficult to get rid of, if not impossible to get rid of.
So there were overpromises to plan participants?
That's correct. That's correct.
There have been proposals to provide, for the first time in history, federal taxpayer dollars to prop up failing plans. We're all aware of those. How much money, in terms of federal taxpayer dollars, would the government need to provide these plans in order to solve this problem permanently for all multi-employer plans?
It is, I can't give you a number, but it's much more than it's exponentially more than is required to keep PBGC solvent. The level of benefits that are promised under plans are up here. The level that we guarantee is down here. And I'm focused on making sure that that guarantee works. And as you mentioned, there are other people who would like this level of promised benefits paid. It would help us with the lower level if the people who made these promises never come to our door. So any amount that can be provided to plans keep them from coming to our door would help us. But
tens of billions of dollars?
Yes.
Or more?
Much, yeah, or more.
Okay.
Yeah, the difference, as I said, the plans are about 50% funded, or a little bit less than 50% funded on the whole. And if you wanted to fully fund them all up, you'd need a lot of money.
Director Reeder, most independent observers agree that multi-employer pension premiums are too low, as you've said. The size of the deficit indicates that the government has been undervaluing the risk of these plans. How much more would a private insurer need to charge to insure these benefit promises?
Because of the unique aspect of what we insure, I can't give you that number. And you might think it's a little disingenuous of me to say they're undervalued, but I assure you it would be a lot more than what is being paid. I can't give you the number. The main reason is because in the insurance world, they not only get to set their own premiums, but they get to regulate more as to what the insured people do, and it's very it's also difficult to raise the premiums after the accident has already occurred. And I won't say the accident has occurred, but we're a few hundred feet in front of the brick wall and we're moving at very high speeds. So it's very difficult to raise the premiums to a market level immediately.
Thank you. My time has expired. I now recognize my ranking member and good friend, Mr. Sablan.
Again, thank you very much, Mr. Chairman, and Mr. Reeder. I appreciate you saying in your testimony that legislation is needed to address the looming insolvency of the multi-employer pension program, and I agree. As you may be aware, Congressman Neal recently introduced legislation, H.R. 4444, that would provide low-interest loans to failing plans and potentially other financial assistance through the PBGC. Most of the Democratic members of the Health Subcommittee are co-sponsors of Mr. Neal's bill, which, most importantly, does not cut retirees' pensions. One, has the PBGC had an opportunity to review Mr. Neal's bill? And if so, what are your thoughts on it? If not, when will you finalize your review and analysis of it, and will you share it with us when it is completed?
We have not had a chance to review it fully. We are looking at it closely. It is very difficult to evaluate exactly the effect and the cost of the program because each plan is plan-specific, and we don't have data from plans that we need to see how that would affect each plan. And other loan proposals have actually gone to plans and sought out their advice on whether or not the loan proposal will cure their problem. But we can't, it's difficult for me to predict when our analysis is going to be done, but I assure you we can share it whenever we have it.
Thank you. And so I would go to my next question is, has the PBGC reviewed the other proposals put forward by UPS 1 and the National coordinating committee for multi-employer plans? And if so, again, what are your thoughts on those proposals? If not, when will you finalize your review and analysis of these proposals? And will you share it with us when it is complete?
Again, we can share our analysis with you, but as I said about the other proposal, it is very difficult to evaluate the loan proposal on a plan-by-plan basis, and we need to do that because we need to look at whether or not it resolves the problem for the big plans that are facing imminent insolvency. And we don't have access, we have to go through the plans to get access to that, and so far we've been unsuccessful. But we do think that the loan proposals all would clearly have an effect, but exactly what that effect is, we don't know. And whether or not it's going to resolve the problem, and again, we're talking about a problem up here, where promised benefits, not a problem just for PBGC. Whether or not it resolves the problem, we can't say. Although we're a little bit skeptical because we think that maybe the assumptions that are being used by the people who are proposing the other proposals may be a little rosy.
All right, thank you. Mr. Reader, and the committee chair is here, very strict on time, so let me try and get to my next question. No, I believe that one of the most attractive features of Mr. Neal's bill is that it does not include cuts to the pensions, retirees' pensions. So we should do our best to protect what was promised to these hardworking Americans. And let's be clear, the pension benefit that those in multi-employer plans receive is often quite modest. For instance, I understand that the average pension paid by the mine workers plan is $530 a month. So could you please talk about the pension benefit range among multi-employer plans? And we only have 48 seconds.
Yes, the benefits vary greatly. There are plans that have very modest benefits, and as you pointed out, the coal miner plan has much more modest benefits, and the Teamsters have a higher, much higher level of benefit, and so a reduction to the PBGC guarantee level would affect the Teamsters much more than the coal miners, but they will have an effect on both groups.
All right, I'm going to yield back my time, but I may submit other questions for the.
Yes.
Thank you, Madam Chair. I yield back.
Thank you, Mr. Sablon. Dr. Rowe, you're recognized for 5 minutes.
Thank you, Madam Chairman. I, too, want to thank Andy Banducci, who sat by me as I sat in the chair for 6 years. So, Andy, thanks for your friendship, and thanks for the hard work you did on behalf of the committee. First of all, Mr. Director, and I appreciate you coming by the office and speaking with me. I can see myself sitting out in that audience concerned. My father was a union member, lost his job at 50. It was offshored, and here he was, post-World War II, no job and no pension plan. So I can see myself sitting there, and it looks to me like that we have two very conflicting issues here. One, the BBGC's current funding can't meet its obligations, and two, some of the multi-employer pension plans can't meet their obligations. And I guess the question I have is that if you don't have enough money to pay the obligations, there are things that we have to look at. One, are we paying premiums enough? You've talked about that. Are the premiums right? Has an improving economy, which has improved tremendously in the last year, helped make these plans more solvent and extended that time? Three, can we reduce benefits? That's another option that you have. Increase premiums, improve an economy, reduce benefits. And can you fund, and I've always thought this, you should be able to fund a pension plan above what we allow during good times. Because you see in the 90s when the dot-com was going along, the economy was doing great, we should have upfunded those plans instead of not funding them, I think. And then lastly, I want to ask, have there been any government decisions, any decisions that government policies that have contributed to the failure of the plan? And going forward, do we need a new type of pension plan?
I'm sorry I didn't take notes at the beginning of your question, so there was lots of items. I'm sure you'll remind me if I missed something. But yes, I do think that there's been errors, as I mentioned in a prior question, in the government's behavior in limiting the amount that can be contributed to a plan. And I do believe that those rules have been loosened and people can contribute more in better times. But your point is, will they? And I think with a variable rate premium, we might encourage them to do so in better times. I do think that a different sort of plan is something that should be examined. I am heartened by the various proposals that have been given about having a different plan, but I have to emphasize that from my perspective, it is very important that we not affect the funding levels, we don't adversely affect the funding levels of the existing promises that have been made. And I'm very fearful of new plans having that effect. But I think if there's going to be anything that looks like a defined benefit plan in the future for our grandchildren, I think it's going to have to look a little bit different than today.
Well, the administration's proposed charging underfunded multi-employer pension plans an additional premium based on risk, and Mr. Scott talked about this. How would the PBGC ensure that this new premium wouldn't accelerate the insolvency of already underfunded plans? It's charging them money they don't have.
Well, the proposal, the administration's proposal has a provision that allows for the PBGC to waive up to 20% of the premium in total for plans that it would adversely affect, because we certainly don't want to accelerate the problem. And we would exercise that authority to avoid charging plans that are already close to insolvency or critical and declining, avoid charging them a higher premium. That's just money that goes into our pocket and goes right back out.
So we've defined the problem pretty well. We don't have enough money to pay the obligations. What solutions have the PBGC, it's not your job, but what solutions have you brought forward or you think we could do to help solidify these plans?
Well, there's an array of solutions, and we've been looking at lots of different proposals that have been made that range from government funding to benefit cuts to earlier benefit cuts for a plan that's headed towards insolvency that's going to go to the PBGC. Almost certainly, the earlier they make the cuts, the less drastic the cuts have to be if you're going to cut. And premium increases. But all of those are very politically uncomfortable resolutions.
Thank you, Mr. Director. I yield back.
Thank you, gentlemen. I recognize the gentleman from New Jersey, Mr. Norcross.
Thank you, Chairman. Certainly appreciate you, along with our ranking member, putting together this incredibly important meeting. And as you suggested, we up here might not have a stake in the game or skin in the game. I am a multi-employer pensioner. I understand this. I've been a part of it for the better part of 37 years. That's why I understand how important this is. Director Reeder, thank you very much for bringing it to us. This isn't a red issue. This is not a blue issue. This is not a Republican or Democrat issue. It's an American retirement security issue. Those men and women who literally deferred part of their compensation to have a secure retirement was a solemn vow they made, and they kept their promises. So we need to make sure that we keep our promises and making sure they get their full benefit. I just reminding members here, we promised a lot in Social Security, yet we've made changes for years. So when we hear some of the statistics that you're talking about, 72 plans have failed, what is going to happen, the cost of inaction, you know, the changes. Do you want to leave the defined benefit, go to a defined contribution, which shifts the liability? All these issues come into play. But the cost of inaction, if we do nothing. So let me walk through this. You say by 2025 is estimate. you'll be bankrupt, upside down, no longer can pay premiums. Today, for a pensioner that makes or gets a, let's say, a $70,000, $50,000 pension, which is above the norm, what is the maximum benefit that he or she can receive if that plan goes under?
Today, that amount is a little under $13,000 for if they have 30 years of service.
Right.
A little more if they have more service.
Yeah, it's a rather complicated formula. $12,870 today. If you have a $100,000 pension or if you have a $50,000 pension, no matter what it is, the most you can get if that plan goes under is $12,870.
Correct.
So if we do nothing and plans crash, the maximum anybody can get is $12,870. Is that correct?
Today.
Today. The cost of doing nothing.
But in 2025, they will get less than $2,000.
So the cost of inaction here is the issue that we're dealing with. A couple of issues. You said you were expecting the premiums to increase from $200 million to $400 million. How is that possible? Is that by you're anticipating the increase that's indexed already?
Yes.
And that's keeping every plan healthy? So if a plan goes bankrupt, that would pull away from
that's including a consideration of some plans dropping out.
So you factored that in?
Yes.
Did you factor in the increases on how that might accelerate healthy plans from becoming unhealthy, going into yellow or red zone?
The premiums under their current rate, I don't believe we factored in an effect of the premiums.
Because the more you charge premiums, the less healthy they either have to increase what they're paying or lessen the accumulated benefit, correct?
That's correct, but I think the inflationary increase is not going to have the same effect as a legislated increase. I agree that a legislative increase would have an effect.
So the risk-based premium, shifting here a little bit, is that based on individual plans or companies, or is that risk-based for the entire multi-employer?
Well, the variable premium rate would be based on the underfunding of the entire plan.
Across the board for healthy plans and unhealthy plans. So you would use the healthy plans to pay for the unhealthy plans, correct?
No. If a plan was fully funded, it wouldn't pay the variable rate premium.
So only 100%. So if they're 90%, would they pay the premium?
Yes. I mean, the details of the variable rate are not specified in the proposal, and that the details, you could say, is where the devil resides.
I agree. And again, I want to thank everybody on both sides of the aisle here. The cost of doing nothing is unacceptable. Thank you. I yield back.
I thank the gentleman. I recognize my colleague and friend from Michigan, Mr. Mitchell.
Thank you, Mr. Chair. Mr. Reedy, you referenced earlier in the conversation, with another colleague, that you've begun to look at the loan concept, but in looking at that, you need to look at individual plans. And you've been unsuccessful in being able to do that. Can you share with me why you've had difficulty in terms of being able to look at those plans?
We need more data on the accrued benefits per participant to determine what it takes to make the plan viable in the long run.
And why have you not been able to get that?
Well, it's not something that we collect. I mean, it's not we have a pretty complex 5500 that they Form 5500 that they file every year,
right.
And adding to that would cause some consternation. And we have added to that in the past, but we don't have it right now.
Well, these are plans that are in pretty dire straits, so would they not be wise to simply supply it so that you could have more detailed information since they're looking for a way to avoid insolvency?
Well, with respect to the analysis of the loan program, I think it would be, but we haven't gotten it. We've asked for it.
They declined to effectively provide it,
Right. I mean, we didn't ask for it in a judicial or legal way. We didn't subpoena it or anything, but we said we would like information on how the program would keep the plan solvent, and we have not received it.
For the record, I'd like to ask Mr. Chair that we get a listing of those plans that you've asked, the information, what information you've asked for, and those who have responded, who have not, if you would, please.
Let me just say, we've asked the proponents, and we haven't asked the specific plans.
I would suggest and ask respectfully that you ask the specific plans, since it has a significant impact on our deliberations here and yours, how we address this issue responsibly. You made a reference also in your testimony about the fact that the individual plan teeth have far more successful and we don't have effective teeth in the multi-employer plans. Have you got specific recommendations you can share in terms of how to get better teeth in those multi-employer plans?
Well, the big teeth in the single world is an excise tax, and to charge an excise tax, it's a confiscatory excise tax, sure. And it's something that people want to avoid. And in order to do that in the multi-employer world, and the reason it's been so difficult is it's not clear who you charge that tax to. If it's the plan, then you could make the matters worse. If it's the employer, well, it's difficult to get that legislated. If it's the participants, it's difficult to get that legislated. It's similar to raising premiums.
It also seems to be that by doing that, the ones that effectively go bankrupt earlier are better off, right? Because you're actually imposing the penalty on those that are left standing, so to speak.
That's right.
You talk about the promises made, the current guarantee, which for multi-employer plans are very low. Have you done the analysis of, the reality is, you have plans here that there have been decisions made for a variety of reasons, some poor decisions, some economic impacts. Have you done an analysis of some alternative levels of a guarantee that is fiscally manageable? Have you looked at that in terms of alternate guarantee?
Well, the statute requires us to provide a report to Congress when we determine that we are going to go insolvent, and I think the time is coming up for that, and we need to figure out exactly how we're going to ramp down the guarantee level as we approach insolvency. We don't have a concrete plan in that regard yet.
Is PBGC prepared to administer a loan program that's been discussed in order to help basically push off some of these catastrophes at this point?
Not currently. Loan programs that exist in the government already are generally administered by the Treasury Department or other departments. I don't want to be too cheeky in saying that the assistance that we give to insolvent plans already
right.
is technically a loan.
Yeah.
And we don't collect those very well.
You can be cheeky here, it's okay. Let me just make one comment, which probably is more cheeky than likely, is I think we need to be very careful when we talk about fully funding or using taxpayer funds for fully funding plans, that decisions were made, such as the one you described about increasing benefits when you can, but then you can't ramp them back, because the taxpayers didn't participate in those decisions. So while we do not want anybody, my dad was a retiree from General Motors, to end up without a pension, we need to be careful to balance that, because otherwise we create an incredible incentive to be responsible, frankly. So your recommendations would be appreciated. We need to look at those what the alternatives in the loan programs are, and let's ask those questions and see who responds. Thank you. I yield back. Thank you, sir.
I thank the gentleman. Before I recognize our next questioner, noticing my ranking member's tie, it reminded me of the beautiful University of Michigan maize and blue. But I was also in the stands at the Big House this past Saturday and enjoyed the first half very much. But I would be remiss if I didn't congratulate my colleague from Ohio, thank you. The Buckeyes, for your, doggone it, for another win. That continues on, but there is always next year. So I recognize my friend and colleague from Ohio, the Buckeye State, the victor state this past Saturday, Ms. Fudge.
Thank you, Mr. Chairman. And since it is my alma mater, I really wasn't going to say anything, but since you did, maybe next year.
I think you channeled me.
Thank you so much, Mr. Chairman, and I thank you, Director, for being here today. Just a couple of really quick questions for you. Should you become, or should the agency become insolvent, is there any mechanism by which the government steps in absent congressional action?
No.
Okay. So you need us to act. Okay, that's number one. Number two, I don't like to really talk in abstract. My colleague, Mr. Norcross, asked you about the maximum benefit that could be received should the worst happen. What is the floor? You said the maximum may be $2,000. What would be the floor?
It would be the benefit promised under the plan. And many plans don't promise a benefit that's even that high.
At all, okay. Yeah. So then tell me, what do you think would happen if some of the people sitting here were to only get $1,000 or $2,000 on our economy? Should they not be able to buy medication? Should they not be able to maintain their homes? Should they not be able to send their children to school? Tell me what the economic benefit, if you know, would be if we reduce benefits to a level that people can't even live on.
I don't have hard numbers, Congresswoman, but I do know that many of these multi-employer plans have participants that are concentrated in geographic areas where the effect of a catastrophic decline in their income would have a similar effect on the entire community.
Could this happen before 2025?
Yes, it could.
So we really know that there is some urgency. It may not be 2025. I agree with our chairman that we haven't done this in more than 30 years. It's time to do it. And I think that it's great to look back on mistakes that were made, but the people who are going to be punished today had nothing to do with those mistakes either. And if we make people a promise, we should keep our word. So I understand that there were problems. We need to find a way to solve it. So my next question to you is, if there were any one thing you would suggest that we do to try to make this a better situation, what would that thing be?
I have to say, increase the premiums to keep PBGC afloat long enough to make the promises that the PBGC has made. You limited me to one. Because that's, I think, maintaining the government's promise is the most important promise of all. And if you can achieve that, then you ought to also think about trying to figure out a way to have the plans maintain their promise.
Okay, and lastly, I would say to you, how many people do you think would be affected by an insolvency? I mean, immediately, how many people? Just sheer numbers.
At least 1 million, probably closer to 1.5 million.
And that is catastrophic. I thank you, Mr. Chairman, and I yield back.
I thank the gentlelady. I recognize now a friend from Georgia, one who's had concerns about employees and their future and benefits, Mr. Allen.
Good. Thank you, Mr. Chairman, and I won't talk about college football. Although the Iron Bowl, I am pretty happy about the outcome of the Auburn-Alabama game. But we are here for a serious conversation this morning, and it sounds very serious. I'm trying to find out exactly, it seems like we're kind of going around the issue here. It's obvious that people paid into a program, paid premiums, and that the labor organizations and the employers adjusted benefits at will, disregarding the premium that were being paid in, and how in the world were they able to do that? I mean, how could they just decide they were going to give greater benefits without any regard to the future solvency of the program?
I don't believe that anyone would say that trustees made a decision on benefits without regard to the funding level of the plan. I do believe they all sincerely believed when they made a promise that the assets would be available to pay that promise based on actuarial evaluations that they were doing at the time. However, some plans, probably a majority of the plans, made a promise in a way that it could be adjusted in the future. And they made those adjustments when the economic conditions required it. and they increased contributions from the employer when the economic conditions required increased contributions. So there's, and we're talking about, as Congresswoman mentioned earlier, we're talking only about 1.5 million people. There's 8 million, 8.5 million people out there that are not going to have any problems, and the multi-employer program is doing very well for them. And I think Congressman Norcross mentioned that there are plans that are doing just fine out there, and it's difficult to extract higher premiums from them.
Right. Well, why are some programs doing well, and we've got this one group that is upside down, and like you said, it's going to be an exponential cost to somebody, potentially taxpayers, where we already have a nation that's $20 trillion in debt. I mean, it's not taxpayers that are going to be funding any kind of assistance here. It's going to be, I don't know, 4, 5, 6 generations from now. I mean, we're not funding anything, basically, right now because of the deficit. It's all being passed down several generations. So what is the difference in the premiums in the programs that are successful, or the single employer programs, and the programs that are in financial trouble? What's the difference in the premiums?
They're pretty incredible difference. The singles, the multis pay $28 a head, flat. The singles pay $74 a head, flat. So already you're talking nearly 3 times as much, plus $38 per $1,000 in underfunding. And that's capped at $523 per participant. So a single employer plan can have a benefit, a premium of up to nearly $600 per participant if they're poorly funded.
So it sounds like somebody was misled here. In other words, they said, you pay in this amount and you're going to get this benefit. And you're not going to get it. Is that a correct statement, based on your concern presently?
Yeah, I do think that $9 until 2012 per participant was too little to provide the insurance that we were providing.
Who is responsible for that?
The Congress sets the premium rate. The premium rate is set by Congress. So as I mentioned earlier, that there's been a lot of proposals to allow the PBGC to set the premium rate, but Congress sets the premium rate. Okay. You may be talking about the contribution rate, and the contribution rate is collectively bargained. That's the amount that employers pay out of the employee's salary to pay the benefit.
So Congress has been unwilling to raise the premium because of what reason?
I have a difficult time answering that question, but premiums, I think, are largely regarded by plans and in the single world by employers as a tax. And we don't like to raise taxes. And it's technically not a tax, but it feels like a tax, especially if you're well-funded. And so it's not easy to raise premiums.
Well, I'm asking these questions. I've only been here. This is my 2nd term, and I've learned a lot here.
Gentleman's time has expired.
I yield back.
You'll have plenty more opportunities to hear this, and that's why we're doing it today. I now recognize the gentlelady from Delaware, Ms. Blunt Rochester. I don't recognize her. I recognize the gentleman from New York, Mr. Espalier.
Thank you, Chairman. Mr. Reeder, I had the pleasure of going to one of the UPS garages in the morning when they have their sort of like roll call. I was very impressed with the number of young people, both men and women, that work for that company, the kind of safety measures they take into consideration on a daily basis to ensure that everybody's safe, the professionalism that they had there, including also as well their starting salary. These are young people that are making about $74,000 a year. They have a pretty good health plan and what should be a pretty good pension plan. So this is an example of a union company that I think is emblematic for our nation, what our nation is, what it should be in the future, but yet to have this looming pension issue, right? And of course, you have said that you support not only a potential reduction in the benefits, but also an increase in the premiums and so potentially some infusion of cash loans to these pension plans. What, with regards to the monies, the infusion of dollars, what level do you think this should occur? What's the game plan? What's the length, the period, the calendar period for this to be paid back? And this is critical. Lots of companies go under because they're saddled with these pension issues. And then, of course, they can't cover their employees. And then companies like UPS get saddled with this responsibility. What is, in terms of the infusion of cash and in terms of the reduction of benefits, what can you live with?
I want to make sure that I don't get misinterpreted as supporting benefit cuts. I did mention that as a proposal that has been made, and I think the ultimate solution may be difficult to get without some kind of a benefit cut. And I do believe the UPS proposal has a benefit cut in it. But we don't have a specific recommendation as to infusion level. The administration is not supporting, I won't say they're not supporting, they have not proposed, they have not voiced an opinion on infusion of cash into the multi-employer system. The only thing on the table in our world is a premium increase.
But you said that if we do nothing, it's doomsday down the road. And in fact, these companies, a good company like union company like UPS may find themselves in real deep trouble, further exacerbating this general pension problem across the country. So what do you suggest that if you don't want to itemize sort of like the pension, the benefits that you be willing to, or we will be willing to live with if they're cut, we don't have an idea on the level of infusion that should come forward and the timetable. What is the recommendation then?
Like I said, I am focused. I'm laser focused on the guarantee that we provide.
Okay.
And we think that premium increases that get us $16 billion over the next 10 years, that continue after that 10 years, will keep us afloat for at least 2 decades. But again, I'm focused on the level of our guarantee, and I think most of your question focuses on the level of the promised benefits.
Let me remind you that you're talking about premium increases, and you yourself have said that companies consider this to be a tax. This very same week, as we are talking about so-called tax cuts. So the environment coming from the White House and the majority is not one that lends itself to the survival of this great company, American company, UPS, which should we all protect. I'll yield, Mr. Chairman, I'll yield the remaining part of my time to Congressman Norcross.
Thank you. Just a real quick question. You keep talking about the premium increase. You told me it would not save the pension plan. So let's remind that just extends life support for a very short period of time. Bankruptcy, the #1 issue in causing the deficit in this, the position in bankruptcy. Wouldn't you agree?
Yes. I don't know if it's #1, but it's very high, yes.
With all the calculations we've seen, by far, that and obviously the downturn. We just want to make sure this was caused by other companies going out of business, and those healthy companies that remain take on this liability. Those making incorrect decisions, investments, have liability, but it's minuscule when we compare it to the unfunded liability by those who went bankrupt. I yield back. Thank you.
I thank the gentleman, and I recognize the gentleman from Pennsylvania, Mr. Smucker.
Thank you, Mr. Chairman. Thank you for being here. I want to follow up to some of the comments that Mr. Allen had made earlier, and I'm even newer than he is, my first term, so really just beginning to grasp the magnitude of the problem, and I certainly believe that Those who worked hard all their lives and saved responsibly and have counted on that pension that they were promised deserve to receive that pension. It's certainly not the beneficiary's fault that the pension fund was poorly structured. On the other hand, as was just mentioned, the businesses who are left shouldering this may not have been party to making what turned out to be bad decisions as well, and certainly concerned with any impact that this would have on taxpayers who don't benefit from the plans at all. So it is a tough problem, and I'm only beginning to understand exactly how it works. I specifically want to go back, you may have mentioned this before, and I apologize if you did, but tell me more about the difference between the single employer plans and the multi-employer plans. One, the single fund is doing much better than a multi-employer. Is that primarily because of the premium level that you just described, where single players, employer plans are, you said, I think, are paying $74 and multi-employer pension are only paying $28? Is that why one is more solvent than the other?
I think that's a very high ranking. If I rank the reasons, I think that would be very high, 1 or 2 or 3. But also the fact that in a multi-employer world, a single employer bargains for a compensation package that includes pension and health and everything with the union. And once they come to an agreement on how much the employer is going to have to pay towards the pension plan, the employer makes that contribution to the pension plan, and then the trustees of the pension plan determine what the benefit is. So you have two different entities, technically different entities, making the how much you contribute decision and the what the benefits are decision. In the single world, it's the employer decides to provide this benefit, and they are on the hook for the entire benefit.
So is it a lack of accountability on the multi-employer side?
Accountability is a pretty strong word. I don't think, I wouldn't use that word, but it is, I think there's a disconnect between the people who contribute, the process for deciding on how much to contribute to the plan, and the process for determining.
It sounds to me like a structural, you like to use the word accountability, but you know, the decisions made in regards to the benefit do not align with the decisions that are being made to pay for the
I think the bargainers are very much aware of the benefit levels and the deficit levels of the plan, and so they bargain accordingly. So I wouldn't accuse anybody of shirking their duties. But
I don't intend. Yeah. That's not what I'm implying. But I want to understand premiums paid by the employers.
Yes.
Entirely.
Yes.
And if there are many good multi-employer plans that you said are solvent.
I'm sorry, you're asking about the single world. In the single world, they're paid by the employers.
Yeah.
In the multi-world, they're paid by the plan. They come out of plan assets.
Which ultimately, who is paying for that then?
I think the economists would say the participants are paying because it comes out of that package of compensation that the employer pays, part of which goes to the plan. And so that's an increase in obligation of the plan.
So multi-plans, there are some that are solvent and some that aren't. When premiums are raised, is that on all plans or only on those that are insolvent?
Well, an insolvent plan wouldn't pay any premiums at all. They're already receiving assistance benefits from the PBGC, and it would be counterproductive for us to collect money and then give them money back. And as I said, if there were a variable rate premium, the PBGC would forgive some of that. But right now, in the current law, the premiums are paid by all plans that are not terminated.
Thank you. I have a lot more questions, but I see I'm out of time. So thank you.
Thank the gentleman. I recognize the gentlelady from Oregon, Ms. Matamichi.
Thank you very much, Mr. Chairman, and thank you for holding this hearing. Thank you, Director Reeder, for testifying. This is a critical issue. Protecting retirement security is crucial, and I'm here advocating for the thousands of workers and retirees in Northwest Oregon, although my grandfather was a miner. who count on getting the benefits they have earned. And as you state in your testimony, Director Reeder, if the PBGC multi-employer program becomes insolvent, the result will be catastrophic for current and former workers, for retirees, beneficiaries, and for their families. So in your testimony, Director, you state that in the Pension Benefit Guaranty Corporation's $67.3 billion in liabilities in the multi-employer program, $62.7 billion of that is for 47 plans that are ongoing and have not terminated. You add that these are plans that the PBGC expects will exhaust plan assets and need financial assistance within 10 years. That was also indicated in your recent report. The ongoing financial decline of several large multi-employer plans are expected to run out of money in the next decade. So unless Congress acts, the PBGC is unlikely to be able to provide that financial assistance. And as you noted, the result will be catastrophic. I understand it is important that the PBGC does not publicly name the 47 plans for the same reason the FDIC would not want to name the banks it predicts might fail. But generally speaking, will you please discuss the demographics of these plans, the types of workers and employers and employees participating in these plans, and where they are located in the United States?
I think the short answer is they're everywhere. And there are plans that have been before you, and so I don't think that there's too much, and they're represented by members sitting behind me, so I don't think there's too much secrecy in two of the very large plans. But I think that's underrepresentative of where the people live in those 47 plans. And I have to say that there's actually more than 47 plans, because we excluded from that number very small plans. But I think it's safe to say they're all over the United States.
Is it reasonable to assume that people in the district of every member of Congress, or at least most of them, will be affected by the economic fallout if these plans fail?
I believe so. I believe so.
PBGC?
Nearly every district. It's hard to imagine a district that wouldn't be affected.
So I quoted your statement from your testimony about what's at stake. Can you talk a little bit about, from your perspective, how this might affect our communities, our economy, and our families?
Yes, I think there are plans that are concentrated that have retirees and active workers in more concentrated areas, and there are some plans that are spread out, but a lot of these plans are in the industrial world, and a lot of these plans have communities where they're dependent upon the incomes that the people get from the pension plan. And when the pension plan dries up and it goes down to the PBGC level or below if we become insolvent, it will be devastating on the community because the grocery store and the hardware store and the guys who mow the lawns, they depend on income from those people. Absolutely.
Well, thank you, Director Reeder, and it's pretty clear that Congress must act, and as soon as possible. I think your testimony uses the word urgent. There's an urgent need to address this, and every day that Congress delays in making changes to improve the solvency of the multi-employer program, the more egregious the problem becomes for participants, plans, employers, and the PBGC. We certainly need that action on the part of Congress, and I'm proud to be one of the 39 original co-sponsors of the Rehabilitation for Multi-Employer Pensions Act, which was recently introduced by the Ways and Means Ranking Member, Mr. Neal. This bill will provide an innovative way to help financially troubled plans through loans financed through the proceeds of Treasury bonds. And I urge my colleagues on both sides of the aisle to work with us on this issue so we can reach a meaningful solution for our constituents across the country. And I yield back the balance of my time. Thank you, Mr. Chairman.
I thank the gentlelady and for your words that indicate you're very much committed to solutions. Thank you. Now I recognize the proud representative from Georgia, Mr. Ferguson.
Thank you, Mr. Chairman. And before we get going, I'd be remiss if I didn't comment on my colleague from Georgia's comments about Auburn winning the Iron Bowl. We're coming for you this weekend in the SEC championship game. Go Dogs.
Your time is being used with this.
I understand, but it's an important comment, Mr. Chairman. I got you. Thank you so much for coming today, and I want to agree with your statement that this is an urgent issue, and I also want to express my support for thoughtfully weighing in on our policy decisions and what our options may be, and I think getting ahead of this is going to be very important. It's only fair to the men and women that have worked so many years to guarantee that they've got some sort of comfortable retirement, and it's only fair to keep the promises that were made. So how we get there, I think it's important to recognize that folks on both sides of the aisle are trying very intentionally to find a good solution. So with that, a couple of quick questions for you. How many multi-employer plans have failed already?
They're in the low 70s, I believe 72.
And how many participants in those plans have had their benefits cut before passage of the MPRA?
I don't know how many of them are cut, but the number of participants in those plans is 63,000. But not all of those were cut. If their promised benefit level was below our guarantee, they weren't cut.
All right. How many pension plans for union executives have failed or are failing?
I couldn't tell you.
Okay, that's fine. So another question I have, and I'm going to go back to something that my colleague from Michigan, Mr. Mitchell, touched on, and that's the reporting data. I'm just curious, does the PBCGC have the ability to go into these plans and get very detailed data as a condition of insuring the plans? And so, and I guess kind of what in my mind what I'm looking at is how the FDIC would look at going into a bank and getting information and data. Do you have the same access?
We don't.
I think it's pretty important that Congress have that data. And I mean, if we're gonna get involved in this conversation and be part of the solution, I think that it's really important that we consider getting that data. How would you suggest that is accomplished? Is that something that needs legislative authority to do? Is that something that you do administratively? What's the right pathway there?
Well, I apologize for being too brief in my answer and saying we don't. There's nothing that's that simple. We do collect a lot of data. We could use more data, but additional data not only costs to produce and report, but it costs to analyze and use it appropriately. So I do think that we are probably pushing the limit on what we can collect legally.
Well, sir, not having access to that data, not analyzing and not understanding the problem is about to cost us all a lot. So it may be wise money spent to understand exactly what's going on in these plans, to be for the plans to be as transparent as possible. I think every single one of us, whether it's Republican or Democrat, before we go and make a sizable commitment to be able to keep these promises, we need to understand those plans in the most transparent way possible. So I would say that not having access to that data and not analyzing it is probably way more costly than what you just described. So, but anyway, thank you so much for being here, and thank you for offering to look forward to future conversations. And Mr. Chairman, I yield back.
Thank the gentleman. I recognize the gentleman from Connecticut, Mr. Courtney.
Mr. Chairman, and thank you, Mr. Reeder, for your thoughtful, helpful testimony here today. Again, I just wanted to see if we'd focus again in terms of what the scope of the problem is in terms of families and individuals that are at risk. Again, your testimony said that multi-employer plans basically benefit about 10 million individuals. Yes. And those are the actual awardees or recipients of pension payments? As opposed to the size of their families?
Yes, that's the participants, but they're not all in pay status.
I see. Okay,
but there's some of them that are active employees.
So they're not eligible yet, right? So, but in terms of the population, given the fact that these are like breadwinners the retirement benefits put food on the table for other family members is really, it's bigger than 10 million people, right? Without getting too putting you on the spot in terms of an exact number. And And the exposure in terms of, what you indicated that, the math shows right now is about 65 billion is the shortfall that is looming?
Yes, for us, yes.
Right. So, so again, just to try and, put this in perspective, I mean, I was around here when, in 2008, when this institution moved at Mach speed to bail out the banks to the tune of about $800 billion, and there really wasn't much asked in return in terms of, the banks taking a haircut. There were no premiums they had to pay to get TARP payments. Again, the bill that my colleague from Oregon mentioned, which is not even a payment out, it's really a loan that would be required to be paid back over time based on investments that would be supervised. Again, I just think putting that in perspective, compared to what this institution did in 2008, it's actually a fairly modest proposal in comparison, but the benefit obviously would be to help 10 million plus Americans who, basically paid into their retirements, assuming that there was going to be a promise kept at the end of the process. But I think also it's important to put in a little bit of perspective. Just a couple weeks ago, the House voted to cut the estate tax, to eliminate the estate tax, which affects about 0.02% of Americans. If you do the math, we're a country of about 300 million people. Again, that is a smaller fraction of people who are at risk in terms of what we're talking about here this morning. And obviously, eliminating an estate tax that today has an exemption of $5.5 million for an individual and $11 million for families, that is going to cost the Treasury of this country $200 billion, according to the Congressional Budget Office. So, when we're talking about, we just saw this institution pass, I voted no, but a benefit for 0.02% of the country of $200 billion, and we're really looking at a solution for this problem that really doesn't even involve, it involves a loan that would be paid back to the Treasury. And I just think that this is not that hard to fix. And particularly if you look at the history of what this institution has done in other cases as recently as just a couple weeks ago, these numbers are not as daunting as I think some of the gloom and doom that surrounds this discussion. And I've been on this committee now for ad nauseum with these hearings, and it's time to just, again, put it in perspective and really come up with what I think would be a manageable, fiscally responsible solution that would protect people's benefits. I yield back.
I thank the gentleman. And now I recognize the gentleman from Wisconsin, whose Wisconsin Badgers will hopefully take care of Ohio State this coming weekend. I don't want to sound that I'm looking for retribution, but I am. Mr. Grothman.
Thank you. Well, hope we come through for you. I was over in another hearing on government oversight, so maybe this has been asked before, but I represent a lot of people in the Central States Plan, which, as you know, is a plan that's in a lot of trouble. And a lot of people are scared out there. A lot of people have expectations raised, and all of a sudden, fearful that they're going to get nowhere near what they thought they were going to get. I'm aware that today most people probably are out there on their own 401k. And a lot of people, 10 years ago, they thought they were all set. They had a 401k. All of a sudden they wake up. A couple months later, they are down 30 or 40% of what they thought they had. Nevertheless, I think particularly because of government involvement, it's important that we step up to the plate on these sort of multi-employer plans, particularly Central States. Could you comment on it at all as far as your vision, first of all, of when we're going to get some finality here? We're not going to wait until the last minute. Maybe we'll wait till the last minute, but if you think that we will have some sort of solution before the final minute, and secondly, give us options as to what you think is reasonable as far as helping these folks out.
Yes, I can't give you a recommendation because the answer is political. And the answer is going to have to, political is probably not the right word. The answer is going to require some sort of pain, either from the government, from participants, from the employers, from the plans themselves. And the allocation of that pain is something that this body does, and it's not easy. But the answer from the perspective of making sure that the guarantee of the PBGC is good can come from increased premiums better than anything else. Increased premiums is not the answer for making good the promise that the Central States and other plans have made to their participants. That has to come from either some sort of government funding or participant benefit cuts, or a combination of those two. And I can't hazard a recommendation as to which one of those things.
You feel those two things. You feel, I mean, there are two other things thrown out there, which I guess you could call government funding, low interest loans, or premium increases. Right. You do not feel those are appropriate?
Well, let me reiterate that I believe that premium increases are not the solution for making the promise whole of the plan. Premium increases make PBGC solvent for when the plan goes under. And so the answer to keeping plans from coming to the PBGC has to be something other than premium increases.
Okay, and when do you think right now the Central States Fund will run out of money?
They've told their participants that it will happen right about the same time that we go insolvent in 2025.
Okay, and so right now, if nothing is done in 2025, 1 month you're getting a check and the next month you're getting nothing?
1 month you're getting a check and the next month you're getting almost nothing.
Okay. Percentage-wise, how much? 5%?
Oh, a tiny percent, less than 5%.
Okay.
That's assuming that they go under and we go under.
Okay. And you feel that if you think a premium increase is inevitable?
I think there's a growing consensus for some level of increase, yes.
What is it right now per employee or per wage?
$28 per participant.
For how long? $28 per year?
A year.
Per year, okay. Okay. And how, we're not going to do it, but I mean, if you had to cover the whole thing with a premium increase, how big would that increase have to be?
In our report last year to Congress, we said that it would have to be a little bit less than 5 times that.
Okay, and then if you feel you got that much, then at least prospectively the plans would be solvent?
No, that only protects our guarantee.
Right.
The plan's solvency is going to have to come from some other source besides premiums. It's going to have to come from increased contributions by employers, benefit cuts, or money from the government.
Okay. Thanks much, Mr. Chairman.
I thank the gentleman, and now I turn to my ranking member for any closing comments you might have.
Thank you very much, Mr. Chairman. Mr. Reader, I want to make a personal thank you also to you, because you have, in yesterday's meeting and in today's meeting, you have gone out of your way out of your courtesy to explain this huge, complicated problem and make it presented in a way that I can understand as much as I can. Thank you. And I want to also thank you again for being here today and for providing us, the subcommittee members, a clear picture of the looming insolvency in the PBGC's multi-employer pension program. And I believe that Director Reader is right when he said in his testimony that if the multi-employer program is allowed to become insolvent, the, I quote, result will be catastrophic for many people, current and former workers, retirees, beneficiaries, and their families, end of quote. I would add that I believe it would also be devastating for businesses and our economy. working people, families, retirees, employers, and all of our constituents are counting on Congress to address this crisis and to do so soon. And Mr. Chairman, I would like at this time to ask unanimous consent to insert into the record a November 8 letter to the Speaker, the Senate Majority Leader, the House Minority Leader, and the Senate Minority Leader, a letter signed by 170 a group representing a cross-section of employers, employee organizations, retiree groups, and other stakeholders.
Hearing no objection, they will be included.
Thank you, sir. And it is my hope that today's hearing is a first step toward solving that goal, toward finding a solution to this problem. And as we hopefully proceed toward a bipartisan legislative solution, Subcommittee Democrats and I believe we must do our best to protect Americans' hard-earned pensions. They worked and sacrificed over a lifetime, and they deserve to retire with financial security. The pension that these workers earn throughout their career should be there for them when they retire. That's not a bailout, that's keeping a promise. Again, I want to thank Chairman Walberg for his courtesy and for holding this important meeting. And Mr. Chairman, I yield back. Thank you.
I thank the gentleman, and I too would like to thank Mr. Reeder for being here. Sadly, I'm sure you recognize you didn't even have the benefit of the Sword of Solomon to come up with an absolute solution that would be, well, I mean, the fact that you provided testimony here today that had great clarity of the facts, but also the clarity of your caution relative to solutions. This has been a hearing on PBGC, and it was for that purpose. All of the other issues relative to PBGC are fair game here, and I think we have to get to those discussions as well. But I think this really established some sense of clarity of the challenge that we have and the size of the problem, the difficulty of solutions. And I think as well, it showed us the impact of decisions that were made and promises that were made. So thank you. We have the expression around here, don't let the perfect be the enemy of the good. Well, there is no perfect in this situation, so we don't even have to worry about that being an expression we talk about. But there needs to be some sort of solution. And so I certainly commit to the members of this subcommittee on both sides of the aisle, as well as to you, Mr. Reeder, and I think as important, if not more so, to those individuals that have come here who are really in the throes of this issue as retirees, as employees, as businesses that I see out here as well that have a very personal involvement with this problem, that we intend to work toward a solution. Not perfection, but work toward a solution, and to continue hearings to find that agreement. So having done that, having had this hearing, and seeing no other questions or testimonies to be given, and you and I being here together at this point in time to finish this off, I declare this hearing concluded and adjourned.